Hey everyone, welcome back to the channel. A quick reminder, I'm a welder that's passionate about passive income, so nothing I say here is financial advice. I mean, I'm literally wearing steel toe boots right now and pajama pants. So while I was working and welding away and listening to Nexstar Media, ticker NXST's Q3 earnings call, which is my biggest individual holding, something caught my attention. Their CFO Liang Liha was talking about changes to the quote adjusted free cash flow. Now, you know I've listened to every single Berkshire annual meeting twice, and this reminded me of something that Warren Buffett said in the 2003 annual meeting.
If I don't understand it, I figure it's probably because the management doesn't want me to understand it. And if the management doesn't want me to understand it, there's probably something wrong going on. I mean, people don't obfuscate with numbers, usually without a purpose. And when you run into that, the best thing to do is just stay away.
Now, I sold IBM almost 2 years ago because their adjusted free cash flow reporting felt like financial shenanigans to me. And I didn't fully understand those adjustments, so I took Buffett's advice and stayed away. And of course, IBM then caught the AI wave and doubled. Isn't that how it always seems to go? But after digging deeper, this looks very different. Their CFO Liang Liha mentioned that all broadcasters in the sector reached an agreement with the SEC about how to present these numbers. But first, what is free cash flow? From Investopedia, the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. Free cash flow is supposed to be really straightforward. It's really just the cash that a company has left over after paying for running the company and keeping the lights on. And that's exactly what these SEC changes are pushing for. Clearer, more transparent reporting. So check this out. From their third quarter 2024 supplemental reconciliation materials, and in their changes in definitions of non-GAAP financial information, which is non-generally accepted accounting principles, they tell us that the adjusted free cash flow measure is now defined as a liquidity measure, as opposed to a performance measure, and is reconciled to, quote, net cash provided by operating activities. And when we look at their Q3 24 10Q filing, we see that in the first 9 months of 2024 that their net cash provided by operating activities is $839 million, which is up from $817 million of the same time last year. Their total cash position is up 23% to $181 million. And from the reconciliation table, we see that the changes mainly involve how they count TV Food Network partnership money, the C-Dubs programming costs, and actual cash timing versus accounting timing. So let me explain that last point about cash timing versus accounting timing. It's the difference between cash accounting, which is recording money when it actually changes hands, and accrual accounting, which is recording transactions when they take place, even if no cash is moved yet. So the SEC wants Nexstar and those in their industry to focus more on when the cash actually moves in and out, which actually makes it a lot clearer for investors like myself to understand Nexstar's real cash position. So we'll look real quick at Nexstar Media Group on simplysafedividends.com. I know you've heard me talk about them. A lot of the market thinks that they are a melting ice cube, and they're in an industry that's dying because they are the largest broadcaster in the United States, but they are trying to grow and expand into other things like Spectrum, turning the CW into a mini clone of Fox, meaning that they want news and live sports and original programming. They've got News Nation, which is the largest independent news source that's growing, and something called ATSC 3.0 that could be the next generation of digital television. They have a current dividend yield of 4%, and we see that currently I have 115 shares with $158, average cost per share that's not including any options or dividend income received, and they're kicking me an annual income of $777, but honestly, this stock has been ping-ponging between the high 150s and the low 180s for quite some time. Now, they have a really high dividend growth rate, 27% 10-year CAGR, 29% 5-year CAGR, and they last raised that dividend 25% in January of 2024, so that means they probably have another healthy dividend raise coming in January of 2025. They're currently paying $6.76 of annual dividends per share. Simply Safe thinks that based on the average average price to earnings ratio over the past 5 years that they do look a little bit overvalued. Their dividend yield is way above the 5-year average of 2.33%. I mean, they have no trouble paying that dividend. They have a free cash flow payout ratio of 24%. That's really, really low. They're expected to have $28.30 of free cash flow per share, which easily covers the $6.76 dividend currently. Now, they do have pretty volatile sales growth and earnings growth, but that's expected because they receive a lot of cash in even election years. Total sales are generally up and to the right, and they buy back a whole heck of a lot of shares, down to 33.5 million, and it almost looks like they're trying to take the company private, buying back all those shares. And speaking of buybacks, check this out. From Q3, they're buying shares at an average of $167, which makes sense because the stock's trading at less than 10 times earnings. So their margins are good, not great currently. Except for that free cash flow margin, I like that. It's come down a little bit, but 17 cents of every dollar coming into the business is making its way to the bottom line as free cash flow. And remember, with free cash flow, that's where you pay the dividend. You can carry it as cash on the balance sheet. You can buy back shares. You can do mergers and acquisitions or just reinvest into the business. So one big yellow flag for me is their debt load, which is at 76% of net debt to capital. I'd like that to be a lot lower. I hope they start paying down debt quicker, but their net debt to EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is 3.64 times. So that means it would take 3.64 years of EBITDA to wipe out their debt if they dedicated it all to debt. And then their interest coverage ratio currently at 2.55. That means they have $2.55 of operating income to cover every $1 of interest on the debt. I'd love it if that was at 5 or above to give them a little bit of wiggle room. So those are a few things that I'm not as hot on with Nexstar. Now, I hope to be making clearer decisions going forward, and I want to share something with you that Warren Buffett said at the 2023 Berkshire annual meeting.
I can't recall any time in the history of Berkshire we made an emotional decision. Have we ever made an emotional decision?
No.
No. No. That's in business we're talking about. No, you don't want to be a no emotion person in all of your life, but you definitely want to be a no emotion person in making an investment or business decision.
And that really hits home for me because it's very easy for us to fall in love with a company or its management, but emotions cloud our judgment in investing. And that's why I'm trying to look objectively at all the stocks I own, especially my largest position. But for now, I'm holding onto Nexstar Media Group, but I will be watching it closely because unlike IBM's situation, this change is pushing for more transparency and not less. Did you know you can keep up with my dividend journey by signing up for the free and fantabulous newsletter in the description below, where I share all of these stock moves of the week that was and a few investing thoughts. And hey, Seeking Alpha has a Black Friday special going on until November 5th, where you can save a whopping $90 off their annual premium subscription through my affiliate link below. I want to know what you would do. Would you hold or would you fold? Please share with all of us in the comments below. And remember, I'm just a guy in my steel-toe boots with metatarsal guards, sharing my journey, so always do your own research. And speaking of Seeking Alpha and all their fantastic writers, in this floating little box next to my head, I had the first ever interview with the Dividend Collector. So if you want to check that interview out and see unmasked who the Dividend Collector is, click this floating little box and we will talk to you there.